Welcome to the deep dive. Today we're taking a closer look at Enterprise Products Partners, that's ticker EPD, a really big player in North American energy infrastructure.
That's right. And we're digging into an analysis from the Motley Fool. It's pretty recent, written by Ruben Greg Brewer, dated April 29th, 2025.
Yeah, and the idea here is to figure out what the next, say, 3 years might hold for EPD based on what the Fool is seeing.
Exactly. You know, the Motley Fool's been around since '93, offering investment insights. So our mission today is, well, to unpack their view on EPD.
Especially for anyone listening who's maybe focused on income, right? We want to understand the core business, its stability, and what kind of growth we might realistically expect.
Precisely. So Enterprise Products Partners, they're a major midstream operator. What does midstream actually mean in practice?
Good question. Think of it like the highways and storage tanks for energy. It's the bit in the middle.
Exactly. It connects where oil and gas are produced to where they get processed and eventually used. EPD owns this, just vast network of pipelines, storage facilities, processing plants.
Okay, and the key thing, according to the article, is their business model. They call it a toll taker model.
Yeah, that's a great way to put it, like a toll road. They charge fees based on the volume of energy products, crude, natural gas, gasoline, NGLs, that passes through their system or uses their storage.
So if the price of oil goes way up or down, it doesn't hit them quite as directly.
Not as directly as, say, an oil producer. Their revenue is much more tied to the demand for moving and storing these things. Volume is king for them.
Makes sense. It's about the flow.
Right. And that business model supports a pretty significant distribution yield currently. The article mentions around 6.8%.
Wow, 6.8%. That's certainly attractive for income seekers. So how does a company like this actually grow then, if it's not just about prices going up?
Well, there are two main ways, fundamentally. One is they can increase the fees they charge, the tolls, basically. Usually this happens roughly in line with inflation.
Okay, so modest increases, sir.
Pretty modest, yeah. The other way is to expand their footprint, either building new assets like pipelines or storage, or buying existing ones from someone else.
But the article hints that just building massive new projects maybe isn't as straightforward as it used to be.
That's a really important point.
Yeah.
The whole energy landscape is shifting. You know, you've got regulatory things, the focus on cleaner energy. Some production areas are just more mature.
So fewer giant pipeline opportunities popping up.
Kind of, yeah. It means finding growth purely through building brand new stuff is, let's say, more challenging than maybe it was a decade ago. So their existing network and maybe acquisitions become more critical.
Okay, so with that said, what are they investing in right now? The article mentioned some specific numbers.
It did, and this is pretty telling. They currently have $7.6 billion worth of capital projects already underway.
$7.6 billion. Okay, that's not small change. That still sounds like quite a bit of expansion.
It absolutely is. These aren't small tweaks. These projects are set to come online at different points between now and basically the end of 2026.
And what's the expected outcome of all that investment? More tolls, basically.
Pretty much. The analysis suggests the spending should support steady, maybe modest, but regular annual increases in the distributions they pay out to investors.
How modest are we talking? Did they give a number?
The Fool's estimate is somewhere in the neighborhood of maybe 5% annual growth in that distribution over the next 3 years.
5% growth. On top of a yield that's already near 7%, that starts to sound pretty compelling, doesn't it? Especially for income investors.
It really does. Because if you think about it, 5% growth is, well, it's roughly double the historical average for inflation.
Right, so your income isn't just keeping pace, it's actually growing in terms of what it can buy.
Exactly. The purchasing power of that distribution check should theoretically increase over time, which is, a big deal if you're relying on that income.
Okay, that covers the organic growth from their projects. But the article also mentions something else, like an icing on the cake, consolidation.
Ah, yes, consolidation. Because Enterprise is so large and financially solid within this midstream space, they're in a position to potentially buy up other assets or even whole companies.
So they could act as a consolidator in the industry.
Precisely. If the right opportunities come along, maybe smaller players or specific assets that fit well with their network, they have the scale and the financial clout to make acquisitions.
And what would that mean for investors, potentially?
Well, if they make a smart acquisition, it could potentially boost their cash flow faster than just building things themselves.
Ah, so maybe faster distribution growth than that 5%.
That's the potential upside, yes. Integrating another profitable operation could allow for, somewhat larger distribution hikes down the line. But and this is important.
It's not guaranteed.
Exactly. It's potential icing, not the main cake. Depends on finding the right deals at the right price.
Got it. So, pulling it all together, who does the Motley Fool see this investment as being best suited for right now?
The analysis really points towards investors who are prioritizing generating income now. That big 6.8% yield is the main attraction, clearly.
But with a kicker of some growth.
Yes, the fact that there's a solid path, seemingly to keep growing that distribution, likely faster than inflation, that adds another layer. It means in 3 years, you're probably looking at an even larger payout in real terms.
So less about explosive growth, more about substantial growing income.
That seems to be the picture painted here. Stability and income growth.
And what was the Motley Fool's bottom line? Do they recommend it?
Yes. Based on this analysis, the Fool gives EPD a recommendation. And they do make a point of noting that the author, Reuben Gregg Brewer, doesn't personally own shares, aiming for, an objective viewpoint.
Okay, so let's try to boil this down. If we look ahead 3 years, based on this Fool article, enterprise products partners will likely be paying a bigger distribution than today.
That's the expectation, yes. Supported by those billions in projects coming online.
And there's this added possibility, the potential for even faster growth if they snap up some competitors or assets.
Right. It paints a picture of, a pretty dependable income stream that's also likely to grow, appealing for that income-focused investor profile.
That's a clear takeaway. For those prioritizing income, it seems like a solid story based on this analysis.
Seems that way. Stable core business, visible growth path, decent yield.
Okay, fascinating stuff. So, as we finish up this deep dive, here's a thought to leave you with. We know this midstream infrastructure is essential, right? And EPD is huge.
Absolutely fundamental.
So, thinking beyond just these next 3 years, what other big long-term trends, there may be changes in how we use energy or new technologies or even shifts in regulation, what could really shake things up for a company like Enterprise, either helping them or hurting them and affecting that distribution stability down the road? Something to definitely think about.
That's a great question for the longer term. Lots to consider there.
Indeed. Thanks for joining us for this deep dive.